Today, we're going to talk about how to turn $10,000 into $20,000 really simply. My 50,000 to 800,000 video did so well. I wanted to do a follow up because I understand that's what you guys are looking for when you go on YouTube. So, these are really simple strategies that if you follow, you could potentially double your money in a really short amount of time. So, stick around, should be a pretty good video. Hello, my YouTube friends. Happy Sunday. Today is August 10th. I hope everybody's doing well. Um, Actually, I wanted to talk about one of the people in the comment section did the perfect joke because he used it exactly the way I would have, and I didn't even catch that it was a joke, which is what made it so perfect. So, if you want to sign up for my course on how to do these things, stick around until the end, and I'll be happy to sell you on some silly course that you could potentially buy to sell on some terrible strategy that I really don't advise doing. And similar to the other one, I would use blackjack in this scenario. If you took $10,000 and bet on blackjack, you've got decent odds that you could double it. Now, you might turn it into zero, and that's probably more likely. But there is a possibility that you double your money, and I don't know, it could only take less than a minute or two. And I see that as great potential. Now, as much as I'm joking, I'm amazed at how many people watch the video of turning 50,000 into 800,000. It goes to my general strategy of don't listen to the people on YouTube. I am sorry, there is no magic pill. It works how it works, and you can make even stock trading however you want it to be, where you take on more risk to get better rewards. But there is no solution to mitigating your risk and doing really well with rewards. And I'm going to give you one stock that I think has potential. In fact, I'm going to go into two of them. But I'm also going to go into my normal discussions about what I really think about the markets and how to invest and what people should be doing with it. And again, it really depends on your goals. For those of you who don't know me, my name is Adam Kahn. I try to give a realistic approach to investing if I'm getting people actually clicking and paying attention. And I'm amazed if you make it this far because by the time you realize that I'm just full of it in the beginning, that I'm talking about gambling. And asterisk, this is not financial advice. Please do your own research to whatever you're doing when it comes to your financial decisions. Maybe even reach out to a financial advisor for you, depending on your goals. Anyway, when you finally realize that it's just clickbait and me giving an intro to get people to watch the videos, I understand if you turn it off, but I also think I'm realistic. And I've been seeing too many videos lately of people who are talking about unrealistic things, selling these, strategies on option strategies, and I am happy to talk about any of them. I was a professional trader on the floor of the Chicago Mercantile Exchange for, I don't know, 5 or 6 years. When computers came around and kind of changed how things worked at the exchange, I moved on and started trading more equities from home and taking a longer term approach because it really changes things. My brother was a professional trader on the Chicago Board of Options Exchange where he traded stock options. Both of us, he has a better understanding of the stock options, but I've learned enough about the Black-Scholes model and deltas and thetas and gammas and how the options really work. And I use some of the strategies in my trading as well. But anybody who's telling you you can make 80 to 100% per year or whatever their outrageous, outlandish strategies are, they're selling you their system. You can't, it's not realistic. You might make that over a year, potentially 2 years. You might make it on specific bets that do really well. But the reality of actually making that type of return on an investment portfolio is totally outrageous and very unrealistic. Now, if you want to pick five stocks or less, there's a chance you pick really well and you hit it out of the ballpark and do a great job. In fact, the two stocks that I really like right now are SoundHound and Palantir. And I don't want it heard the wrong way. These are like the gamble stocks. But those could really hit it out of the ballpark. And Palantir, even with as far as it's gone. I was listening to one of the people who I really like, and I'll give him a little shout out, which is Dividend Compounders with Cheese. And he made a really good case for Palantir, even at today's prices, where he had admitted that the PE ratio is very extended and it's probably a little too high, but he went into their growth rate and the earnings and the consistency of how fast it's growing. And I see it as a potential that it could be like Tesla, where it really does have a run for another 3 or 4 years with people scratching their heads saying it doesn't make sense when maybe it does. I mean, they're growing at over 45, 50% year over year, and that's incredible growth. That's what Nvidia was doing, that's what Tesla was doing years ago, and those companies can do that for an extended period, pushing the stocks into the stratosphere until those earnings slow down, at which time they can reverse and have a big correction. Now, they could also do what Nvidia's done, and actually, once they've established those earnings, it's continuing to grow. So I do see Palantir as a potential that it could really drive up to $500 a share, $800 a share, and it could do that over a year or two, even as expensive as it is. The other one I like that is SoundHound, that could also drive those types of returns. The little thing I would be cautious of is the companies that move like that can have really big corrections. So be careful with them. Like, it doesn't mean these are some guarantees, but if you're looking for the pie in the sky, I hope that this thing really pays off and I'm willing to throw a little bit of money at it. I don't see those as such bad options for stocks that could really pay off. In fact, HIMS is one that I have a decent sized position in my account. That same thing, that the PE ratios and the numbers are, way higher than what I'd be comfortable with. But I also see this like what it could turn into and the potential. But HIMS in my account is a complete trade. It's not a company I necessarily want to own for 10 years, but if it turns into something, of course, you want to own anything. But I just trade it. If I am looking to invest money, invest. I look for companies like Amazon, Google, Meta, so on and so forth, and you are not going to make 80 to 100% on those. The other thing is this one woman who I've been watching who sells her course because she's been making 80 to 100% returns. She's making 50,000 a month on her $500,000 portfolio. As far as I'm concerned, there's no way. She's talking about using diagonal spreads to be able to make this, but she totally disregards when stocks pull back and has no recognition that over a 10 or 20-year period, the market has all sorts of types of conditions, and they often can have a 2 or 3 year correction period or go stagnant or whatever. So if you're using leaps, which is some of the strategy that gets used, and the way it works is, let's take Amazon, which is trading $220 approximately, and you go, I think they can get to December 2027. I didn't look on Amazon. I thought it was only January, but I saw in one of the stocks that I looked at, it went as far as December 2027. Well, we're only in August of 2025, so that gives you over 2 years and a few months. You can look at like the 220 calls on Amazon, and I'm guessing that far out, you're only paying $30 or $40 per lead. Instead of having to come up with $22,000, well, you only have to put up $4,000 per option. So you can buy 5 calls instead of 100 shares of Amazon for the same investment dollar amount. That's highly leveraged and takes on a lot more risk than people realize. Because if Amazon just doesn't move over the next 2 years, which I don't really think is the case, I actually think it will go higher. And if it was 30 or $40, to be fair, 3,000, 30 or $40 in Amazon over 2 years doesn't sound very unrealistic to me. Like, I understand the trade. But what the investors and the people teaching these courses don't recognize is, if the market turns, and let's say Amazon is only up $5 in 2 years, you've lost a lot of money. Whereas if you bought Amazon and it was up $5 from where it is today, you've made $500 in 2 years. In the other scenario, on the $22,000, you're only going to have about $2,500 out of your $22,000 or $23,000. the money disappears unless the stock goes up, and it has to go up enough that it gets 20 or $30 higher than where it is today to actually be profitable. Again, I think that in today's environment, it's hard for me to see that not happening. But the people talking about these strategies just think of it as a given because how the market's done recently, and they haven't been investing long enough to recognize that there are real corrections. I'm guessing they weren't around in the dot-com bubble. I'm guessing they weren't around in the 80s or the 90s when we had periods where the stocks didn't really move. And all they see is this market that just goes up and up and up and thinks, Jesus, Amazon's at 220. What are the odds it's not at 260 by 2027? Like, of course it's going to be above that. Probably will be. Doesn't mean it will be. And there's potential that it could be a little bit lower, in which case you would be wiped out of all your money. They also talked about last quarter's earnings, where the stock dropped, I think it was like 15 or 20 bucks per share, and talked about how they had sold some calls against it. Now, this was super convenient because it was one of the few Mag 7s that didn't shoot up higher, which would have a different issue if you sold calls against it, and just talked about the free money that they took for the $900 against their leaps and their shares that they own. But let me explain something. If you own shares and the stock dropped, the value of your account just went down, even if the calls that you sold made 900 bucks. So if you owned 100 shares of Amazon and you sold one call against it and got $900, which I don't think it was one call, and the stock dropped $18, well, yes, you got the $900 for selling the call, but you lost the 1800 for owning the stock. There seems to be a total disregard for what it dropped because, Amazon's just going to go higher over time, so I just ignore what it dropped that day because it's going to go back up anyway, and I just got to collect this free money. Not really. On top of the fact, whatever call that the person sold, and in this scenario, if they actually got 900 bucks, it would have been on one call, it would have been an extremely tight call, even with earnings coming out. Well, if the stock shot higher, well, they would have had to sell their shares against the call, or yeah, sell their shares against the call that they sold. They would have lost the position and they would have been out of the trade. And they would have been bragging about how well it worked because they sold the call, they got their 900 bucks, and geez, I sold my shares at $240, even though now it's trading at 270. Because what's the difference? I mean, I was happy to make what I made. Well, you gave up what it would have done if you just owned the stock. Now, companies like Amazon and Google and so on, I just want to own. I might sell really out of the money calls, figuring, geez, if it goes there, like I think I sold a 300 call in Google for December, and all I get is $40 or something. It really isn't that much money. But if it gets that far and I'm making $100 a share, I guess I would sell 100 shares. I don't really want to sell Google, but to me, it's almost like a free $40, even though I know it's not free because it happens from time to time. But it's not huge returns. It's just a little bit extra money in your pocket. And when I challenged the person and kind of said, look, something's not making sense to me about what you're trying to explain, and legitimately, I'm curious because if you have some strategy that makes that kind of return that I'm unaware of, I would be curious. And the response was, well, you have to buy the course to learn. Yeah, super convenient, but I'm not about to buy some course that's going to tell me what I already know about trading in this fantasy world of you've come up with this wonderful solution where you're making $50,000 a month consistently and it's so easy, but you're going to sell this course on the side and do these YouTube videos and try to create this extra revenue instead of just trading bigger with your super simple strategy. The funny thing is I love when somebody like that will post their account and how well it's done. And quite honestly, so she put $110,000 in an account. Sorry, I'm trying to remember. That turned into 125,000 over like a 5-month period, which is not the type of return she's talking about. To show, because she had made $6,000 in like a week or two with some of her options trades, still not getting her 80 to 100% per year. She's making, she made 10% in whatever the time frame was, and doing just fine and doing really well in a market that was super bullish from April till currently. But then when she updated on selling the calls is kind of when I questioned her, saying, well, where's the account value now? And doesn't post it, doesn't show it, and just says to me, well, it's 135 now. And I'm thinking, well, maybe, but how's that possible considering the stock dropped in price and you made $900 selling calls? Hard to imagine unless there's something else that was going on that you aren't showing and you aren't talking about, which of course you'll sell me the course to see. Either way, my whole point is be careful about what you're watching, what people are telling you, and if they're selling something that goes with it, that maybe those are the reasons it's doing as well as they're telling you. The other thing is you should really do a hard look at yourself and your goals and what you want to do with the money. Do you work a job and you don't really want to learn about investing in the stock market and everything else? Great. There's something for everybody. And if I can save you a couple percentage from hiring an advisor, what I would recommend, not investment advice, even though I just said this is what I would recommend. You need to do your own research. You need to talk to an advisor, your lawyer, your accountant, or somebody, not me. That being said, what I've done for my son, because I don't think he finds this stuff interesting. Like, I'd like him to, and I talk about it all the time, but deep down, I don't think he cares. He thinks he wants to be a lawyer, he wants to go work a job. So, what I suggested to him and what I've set up, like, I have a little account that I've done for him, and we put $20 a week into it, is he owns VOO and QQQM, which I will explain what both of those are. And then he wanted to buy some Spotify and he actually wanted to buy some Meta. So he has a couple of shares of each of those. But the reason I've told him to do this is VOO tracks the S&P 500 with an exceptionally small expense ratio. So instead of having to hire an investment advisor for 1% or 2% of the portfolio value per year, I think it's like 0.01 it's like $10 or something on every 10,000 invested. It is minuscule, but it is a tracker of the S&P 500. It is not one stock. It is a compilation of 500 stocks. So it is very well diversified by owning this one ETF. He's also bought QQQM, or I've bought it for him. QQQM mimics the NASDAQ 100. What I like about that is the NASDAQ is tech investments. I think they'll outperform with him being 14 years old, even if they have bigger corrections and everything else. By the time he's 40 or 50, I would hope that that's gone up significantly and outperformed the S&P, but the S&P is a little bit more stable. QQQM is not, even though it is one ticker, it represents 100 stocks, 100 different companies. A lot of them overlap the ones in VOO, so there's a little bit of an issue there for anybody who actually wanted to dig into it. But I think that really gets him pretty well diversified. He's invested in the markets. And if he goes and becomes a lawyer, he can just continue to buy those two things and be invested without having to think about it much. There are also ones that invest in the entire US stock market. There are ones that do international. There are ones that go by sector. ETFs are a great option. For me, just being in the S&P 500 for somebody like, so I was asked to help manage the portfolio of a charitable trust. It's an organization that I'm on the board of. I really like it. It helps me chat with some friends once a year, and it also, we give to charities, which I find is really nice, and it's a way that we give in a way that I couldn't afford, but by piling it together, anyway. But they asked me to help with the financing, and I freaked them out when I said, why don't we just put it in VOO and be done with it, and kind of pick a percentage we want invested in the stock market and not think about it. And whoever can be treasurer, like, you don't need me to be treasurer. We can kind of just set a guideline of how much we want in the markets, and every year they can adjust and put the rest in CDs or a high yield savings account and just be in VOO. Well, it kind of freaked people out thinking, well, we only have one stock. So I spread it out to VOO, QQQM, and I want to say the other ticker is VTI, but I don't remember. I researched one of the international ones to kind of, but VTI might be the US one. I'd have to actually look in it. And what I've done is set up parameters of, I'm making it up because I don't really remember, but whatever it was in the guideline of, 35% in VOO, 25% in QQQM, and either 10 or 15 in the other, and then 20 to 25% in CDs currently, or high yield savings account, so that we have some cash. And just each year, whoever's the treasurer can adjust to what those percentages are, where they don't even have to watch it. Now, if the market has a bad down year, it will as well. It's not like it's not part of the market, but this is a way that they can be invested without anybody really having to know much about the markets, or understand it, and be able to avoid a lot of expenses of having a financial planner. And again, when I tell you to figure out what your goal is about with the money, what I love about the stock market is it can fit anybody. If you want big and boring, there's big and boring. There are things that move very little. If you want something that pays a monthly dividend, there's plenty of things to choose from. Anything that's somewhat safe to very safe to super risky. If you want high growth, or taking a shot, I gave you two examples of taking a shot. Like, and there's zillions out there. If you just want to take a shot, there's tons of stories to put a little bit of money and hope you hit a home run on. And if then you have some money and you actually want to be invested, there are plenty of stocks that I think are just good investments. If you wanted to find what I think is the best bargain out there right now, I've started looking at, and I really like United Healthcare. If you want to know my strategy, what I think is, what's the total investment I would want to put in United Healthcare? I see some risk in it, and then I put a percentage of that in where it is currently. So for me personally, to overshare, I probably would want to own about 400 shares if it triggered my levels and it got to where I think it's going to get. But I think it's going to take time, which is why I want to talk it through. I think we still need the lawsuit with the Department of Justice to kind of play out. I also think people aren't going to feel more comfortable until they start seeing the earnings start to show some life again. If people in the know are going to know that about the earnings before we see it, which I talked to my brother about. I love watching the guys who do all the analysis and all the information on all the stocks and sit there and talk about the growth rates and the earnings and how things are doing, and they have their concepts on how a stock is going to do. That's all well and good. And I don't do a lot of that on purpose, because what I find is eventually it's going to make sense anyway. When a stock shows that their growth rate, their revenue, and their earnings are doing well, but the stock is lagging and you can't figure out why, and for 8 quarters it just seems to keep doing better, and then all of a sudden some news comes out for these problems that they've been having while those numbers are like that, that all of a sudden makes sense as to why the stock hasn't been going higher. And whoa, what a shock, now it starts to go down. As well as vice versa. You'll have information on a stock that doesn't seem to be growing at the rate you think, but the stock price keeps going higher and higher, and you're scratching your head saying it doesn't make sense. And then all of a sudden they seal some government contract that now it makes sense, and the stock shoots higher, and everybody gets excited and they start buying it, and it's already priced in because somebody already knew, or something was going on where the books didn't match the information as to what was really going on behind the scenes. So I don't dig into the financials the way that some do. I do look at it, I do my research, I look at things like, I know I've talked about Target. So I look at their free cash flow and I look at their dividend to make sure I'm comfortable that they can be able to pay that dividend going forward. Sometimes I get caught. I got caught on Whirlpool, but even where they cut the dividend to, I think it's still a decent investment. It's just not the steal that I thought it was. Anyway, back to United Health. I think they're going to need to see that Department of Justice case kind of finish, which I don't see happening within 6 months. So I think you've got 6 months to a year of that continuing before it's finally finished. And then I also think you're going to need to see some improvement in the earnings before the stock actually goes higher. So I've bought 25% of the position. I have 100 shares. That way, if the stock goes higher, well, at least I have the trade on. I'm in the market. I have the one that I think is undervalued. At the same time, I haven't shot all my bullets. And then what I did recently is I sold a November put at 220. I think I talked about a while back that I had sold a September 250 put. The reason I don't like follow up on these is when the stock went up to over 300, the put had fallen down so much. I think I sold it at 10 or $11. It was only trading 2 or 3. I kind of sat there and thought, why would I sit there and hold it for the $2 or $3? It wasn't because I'm some genius that, oh, I saw it going to fall again. I really didn't think it was going to. But the way that the margin works in the account, if I'm short a 250 put, it's tying up to $25,000 in the account that I can't use for something else. So it was more like for the $200, it was a good trade. I didn't want to hold it another month and a half and not be able to have access to the funds. So I covered it. And now that the stock has fallen back down, I actually was able to freed up the cash to be able to buy the 100 shares. And I actually deposited a little to be able to sell the 220. Now, same thing. It's hard for me to follow up on it, but if it drifts back up to 270, 280, or even $290 a share, well, maybe I end up covering that put if it gets cheap enough. Not because I'm really trying to trade it. I sold the 220 put figuring if I end up putting on my second 100 shares at 220, it seems like a decent level. I got paid $11 to put on the trade, so I picked up $1,100. And if the stock goes higher, I get to keep that money. And if the stock goes lower, well, I might get assigned the shares at $220. And depending on how I want to look at it, I can think of it as 219. Now, that's not what I do. I think of it more like a dividend. I feel like I paid 220 if I get assigned the shares and that I collected an extra dividend. I might sell a call against it. Like, I don't know what I will do with United Health, but I do think that they're undervalued. I think making $16 a share for a company that's been growing their dividend at an exceptionally high rate, that has a lot of things going on weighing on it to make it be bad. But I also recognize the risk that things could get really bad for them, which is why I don't want to just jump in and put my entire position in. If I get assigned that other 100 shares and something comes out that concerns me that, boy, they could really go to zero, I don't think I'll just keep blindly adding on. In the meantime, if the board members continue to buy shares, and especially if I notice that people in Congress and Senate and potentially Nancy Pelosi is buying United Healthcare, maybe I'll get more comfortable that things aren't going to be so bad. They're not going to go out of business. It's going to get washed over, and maybe they'll get some new contract that's really good if our congressmen and senators are buying it as well. But I don't just jump in with both feet, especially when there's bad news. I know I talked about Boeing for a long time. It was the same thing. I put on an amount that I was comfortable with. My attitude with Boeing is I don't know that I want to own it forever, but it was such bad news. I feel the same way about United Health. I kind of see my timeline as 3 to 5 years. And what I hope is maybe I get lucky with the timing that it's so oversold that when things start to wane and they're not in the news for such negative stuff, if I get lucky and double my money in 3, maybe 4 years, I can then take what I've doubled and put on twice as big a trade into something else that I see a similar situation. The ones I've done that with recently was Boeing. Then I did it with Nike. Now I'm trying it with United Health as well. Otherwise, I really just try to invest in what I think is the biggest and the best. Amazon, Google, Meta. I have Chevron so that I have some oil. I have Microsoft. I have Starbucks. And look, I'll use Starbucks as a great example because I bought in at a terrible price. I think I own it from $117 a share. I still think that Starbucks is the biggest and the best in the beverage business. So just because it's gone against me over the past 3 or 4 years hasn't changed my mind on why I bought it and what I think of the company. Maybe it never does well. Maybe I only get my 2.5% yield from where I bought it. And maybe things improve over time, especially with Chad Nichols. Chad, I think it's Chad, but Nichols, the new CEO. I'm hoping that he really starts increasing revenue. They've talked about being able to sell off the division in China, which might be really good because I think there's some issues with how to deal with the governments over there and how they handle things versus how we do things in terms of earnings and sharing information and whatever else, to be able to focus on the US again and maybe change some strategy and grow the company. Now, this has hurt their free cash flow, but what I really think is that's a short term thing to try to change direction. And if it doesn't work the way he's hoping, maybe he can shift. Now, I thought the same thing about the woman who went on at Foot Locker, and they've had terrible struggles ever since she was on, but she did great with Ulta Beauty, so I assumed she'd be able to transition at Foot Locker, and it hasn't quite gone the way that I had hoped. But that happens too. So I make these educated guesses. Sometimes it's right, sometimes it's wrong. Now, I'd appreciate if you put in the comments, what do you guys think about United Healthcare as well? Do you see it the same way I do? Do you think it's creating an opportunity? Do you think it's time to just dive right in? Or do you think similarly it's time to buy 20, 25% of what you'd want and kind of keep an eye and continue averaging into it if it gives you better opportunity at lower prices? Just kind of wondering what others are thinking. And do you see any other bargains out there? Because to be fair about the doomer and gloomers, I do think the market's probably a little bit overpriced. The one interesting thing about it is if you take the Magnificent Seven out of it, I don't think it looks so overpriced. There's a few companies that seem extremely stretched, and extremely is not like the .com bubble, especially because their earnings are pretty secure and it's a little bit different of a scenario going on. But it does seem a little bit stretched, not stressed, but not out of control, where the others seem totally reasonably priced. And I see some good deals out there as well. United Health being the one that I think is like the best bargain. I also think well, I guess United Health would be included in this, that healthcare in general seems a little bit discounted because of what's going on with the current administration and them trying to make prices more competitive and better for the consumer. That might hurt some of the healthcare companies for the short term, but I find over the long run, these are just bumps in the road. And companies that have been around 20 or 30 years usually figure out a way to adjust and work through it and do just fine. Anyway, I hope your Sunday's going well. I'm going to go put this together. Please forgive the unshaven, the t shirt. My hair might be a little bit messy and stuff. Just the family's still asleep, so I didn't want to wake anybody up and go clean up before doing the video. I hope I haven't offended anybody. If I have, that's okay too. Um, if you haven't already, hit that subscribe button, smash the like button, make some comments, let me know your thoughts on United Health. And again, let me know if there's any other bargain out there because I could take a look at it myself. The one thing is, sorry to ramble on. So you guys know, like I'm getting to a point in my life where I've been working less, relying on the dividends more. So it's not like I'm generating income to be able to push into to grow some of these, and more that I've talked about that I separate three accounts so that I have the set it and forget it, which I really forget it and don't pay much attention to. I have what I call my dividend account, but I make enough trades in there and change things When Amazon had bad earnings and the stock fell, I actually sold some of the dividend stuff and bought some more Amazon, even though that's one of my biggest positions in the set it and forget it. I just feel like the market is still bullish, so pullbacks are opportunities to buy into really good companies. So, like I said, that's what I did with Amazon. And I even have some Google in there as well. And I wouldn't really think of those as dividend stocks in my dividend account. And then I have a much smaller account, like way smaller, that I aggressively trade. Now, I don't want people to overthink that. It's not like I don't try to trade daily or flip in or flip out of things, but I'll use, for example, HIMS. Like that's the one that I have the most active trades on. And I'm long the stock, but I'm also short calls and I'm also short puts. And my timeline is I'm selling the September 19th, that quarter's options. And then wherever the stock moves over that time, I'm collecting the premium on the options that I've sold. And then it'll potentially change the amount of shares I have when that time rolls around. And I'll readjust looking at maybe the December options or maybe November if December's too far out. And I try to pay attention to when earnings are coming out because volatility goes up pretty high as you get closer to the earnings. So I don't, sometimes I'll want to wait until closer to earnings to sell again. Anyway, that's what I'm doing with the trades I put on. I'm happy to go into detail more of actually what positions I have on if people are curious. But I try to trade that pretty aggressively in hopes to turn that account into a real amount of money that I can then use for other things. And because I find it fun and I like to see how I do. Anyway, again, I wasn't supposed to just ramble about what I'm doing in my trading account. I just wanted to talk about how to turn 10,000 into 20,000 and then explain that it's pretty hard to do using investments. And the people selling you on how to do that in whatever time frame, be real cautious about that. Again, not financial advice. Do your own research. Um, hit that like button and subscribe button, make some comments, and have a great weekend. Bye bye.